the world blew up in 2008. The world is now entirely about the management of the debts. That is everything now. And there are two ways for that to happen. If we didn't do quantitative easing in 2008, 9, 10, 11, all of that stuff, the world would have burnt and destroyed in the manner that you thought, which is like the Argentina collapse, the Cyprus collapse, this huge destruction. What we chose was a glide path.
Real Vision founder and CEO Raoul Pal revealed his insights into the great unraveling of the global economy, a term he coined to describe the impending economic collapse. Raoul's deep understanding of macroeconomic trends allows him to connect the dots and provide valuable context to investors and market watchers alike. Raoul begins by explaining that the world is on the brink of a monumental debt crisis. This situation is the result of central banks' attempts to stave off economic collapse following the 2008 financial crisis. By injecting trillions of dollars into the economy through quantitative easing, central banks have created a precarious environment characterized by excessive risk-taking, artificially inflated asset prices, and ballooning corporate and sovereign debt. According to Raoul, this massive debt burden is set to trigger an irreversible chain reaction that will ultimately lead to the Great Unraveling. He emphasizes that the global economy is an interconnected system, and when one domino falls, it's only a matter of time before others follow suit. Let us now join Raoul Pal as he shares his insights on economic growth, population, productivity factor, and high debt issues. Sit back, hit the like and subscribe button, and enjoy the video.
Is it something I call the magic formula? Magic formula is economic growth. Economic growth is driven by three factors and three factors only at long-term level, aside from just the normal business cycle ups and downs. Population growth. The more population you have, the more your economy has activity. So population growth, population shrinking the entire Western world. The only way of offsetting that is immigration. But we talked about the fact that the workers are angry, they can't get wage rises. There is less of a desire to have immigration than there was maybe 20 years ago. So most countries have started to restrict immigration. Fine. So there's no way of solving the population side. The next part of the magic formula is productivity. That's how much output each of us can generate for the economy, and that becomes more efficient. Problem is, it seems to be a function of demographics too, and productivity has been declining since the 70s. Well, actually since the 50s. So productivity is going down. The population is shrinking over time. So the answer was debt. The answer all the way through this equation from these people who were sold the American dream back in the 1950s, the baby boomers. They're listening to Elvis Presley, getting into the Beatles. They're like, let's go, the American dream, I'm going to get rich. But as we pointed out, their wages never went up. But because there were so many of these people, they competed for houses and houses went up. They invested in the stock market went up. Everything, all assets got more expensive because of their demand. So they did the rational thing, which is I'm just going to borrow money. And the difference between the rise of the assets and their wages is essentially what the debt was. The debt side of the equation is what the government's done too, because GDP is declining. The trend rate of GDP keeps going down. If you see the Chinese economy, and what happened is they did the same. They had population coming in, productivity probably rising, but then they massively borrowed money. So they had the fastest growing economy in the world for a long period of time. Leverage gives the illusion of growth, but obviously it has a payback later. And this is the payback we've got now. The leverage that the baby boomers took on, their governments took on, and the corporations took on for all of this issue is what we're dealing with now. So wages didn't go up, assets went up because they were competing for them, like you're competing for scarce resources of people right now. But when you put 76 million people in, the housing market goes up. The stock market goes up because they start pension plans and stuff like that. So the difference is debt. And that was okay. Although we were all starting to look at this saying, whoa, this is now getting absurdly debt laden. The government's 100% of debt. The private sector's 100% of debt. Households are 100% of GDP in debt. It's like, whoa, this is out of control. Then 2008 comes along. And that is the debt crisis. I mean, every fucking bank blew up. I mean, everything blew up. It was a complete, total collapse. And that rolled on into Europe in 2012 when the governments, Spain, Italy, etc., blew up. And all the banks in Europe blew up.
Raoul highlights that corporations are more indebted than ever before, with some industries, such as the energy sector, already showing signs of distress. As these companies struggle to service their debt, defaults and bankruptcies will become more prevalent. He also points out that countries like the United States, Japan, and Europe are all grappling with unprecedented levels of debt. When these governments can no longer service their obligations, the bond markets will come under severe pressure, leading to higher interest rates and even more economic hardship. With banks and financial institutions exposed to both corporate and sovereign debt, the domino effect will put immense strain on the system, leading to the possibility of a widespread banking crisis. Let us now continue with the video, as Powell talks about hyperinflation and current wage levels around the world.
Hyperinflation is when you issue more money to pay your debts, and it comes in an endless cycle because you're not generating GDP growth, so you just keep printing money. So an excess of anything in extremis, everything becomes worthless. So if you're thirsty and you've come out of the desert and somebody gives you a bottle of water, you'll pay pretty much anything for it. If somebody's there with 1 million bottles of water, what's a bottle worth to you? Almost nothing. Once you've had the first one, right? So anything in excess supply, just supply and demand. Too much supply of currency, the value goes down. So what happened in Germany is they had these gigantic, impossible to pay debts to the West. So they printed as much money as possible. That blew up spectacularly. Prices rose millions of percent. And every time you got paid as a German citizen, that fistful of notes barely bought you a loaf of bread one day and half a loaf of bread the next day, and then nothing at all until you have wheelbarrows full of cash. And we've seen this in Argentina. We've seen it in Venezuela. We've seen it in plenty of countries. We just saw it in Lebanon recently as well. That's a total collapse of the value of a currency. Okay, so therefore, all of your productivity as a human is devalued as well because you can't buy anything. So you end up having to ignore currency and barter. And we've seen that in many places as well, because the value exchange of a currency in the middle, because it falls so fast in value, it's a nightmare to deal with. And it's a total destruction of wealth, except those who own assets. Real wages have not gone up versus prices.
Okay. Meaning
so prices rose more than wages. So if you look at peak, I don't know what peak wages were, but let's say they were 6% last year, year-on-year wage growth, but peak prices were 9%. So people actually got poorer, which is why we've got a recession going on, because everybody lost purchasing power versus just basic goods. By every indicator I've got, we're in a recession already. And it will become more abundantly clear. The other thing I think is a point that's also important is we need to think about total aggregate demand within an economy. And who are you giving those increased wages to, right? So yes, you are paying more for scarce labor, certain skill sets, expertise, whatever. But when the labor force participation rate is only 65%, you have to average that over 65% of the economy, not 100%. And that's the function of demographics. So there's a whole bunch of people who are retired whose wages can't go up, which is retirees, which is basically that 35% is that bucket plus people who've opted out. So you actually reduce it by that. And the labor force participation rate is actually a function of the birth deaths rate forward lagged 30 years. So what we know is we know in the future that there's going to be less and less people in the workforce, which is interesting. And it actually mirrors inflation, GDP growth, everything's driven by this monumental demographic issue. So yes, you're paying up for wages, but your margins have gone down anyway because the other costs of input. So real wages for everybody have actually gone negative, massively negative, which is why everybody's feeling the pinch.
Global growth has slowed sharply, and the risk of financial stress in emerging market and developing economies, EMDE, is intensifying amid elevated global interest rates, according to the World Bank's latest Global Economic Prospects report. Global growth is projected to decelerate from 3.1% in 2022 to 2.1% in 2023. In EMDAs other than China, growth is set to slow to 2.9% this year from 4.1% last year. These forecasts reflect broad-based downgrades. The surest way to reduce poverty and spread prosperity is through employment, and slower growth makes job creation a lot harder, said World Bank Group President AJ Banga. Most EMDE have seen only limited harm from the recent banking stress in advanced economies so far, but they are now sailing in dangerous waters. With increasingly restrictive global credit conditions, 1 out of every 4 EMDEs has effectively lost access to international bond markets. The squeeze is especially acute for EMDEs with underlying vulnerabilities such as low creditworthiness. Growth projections for these economies for 2023 are less than half those from a year ago, making them highly vulnerable to additional shocks. The world economy is in a precarious position, said Indermit Gill, the World Bank Group's chief economist and senior vice president. Outside of East and South Asia, it is a long way from the dynamism needed to eliminate poverty, counter climate change, and replenish human capital. In 2023, trade will grow at less than a third of its pace in the years before the pandemic. In emerging markets and developing economies, debt pressures are growing due to higher interest rates. Fiscal weaknesses have already tipped many low-income countries into debt distress. Meanwhile, the financing needs to achieve the Sustainable Development Goals are far greater than even the most optimistic projections of private investment. The latest forecasts indicate that the overlapping shocks of the pandemic, the Russian invasion of Ukraine, and the sharp slowdown amid tight global financial conditions have dealt an enduring setback to development in EMDEs, one that will persist for the foreseeable future. By the end of 2024, economic activity in these economies is expected to be about 5% below the levels projected on the eve of the pandemic. In low-income countries, especially the poorest, the damage is stark. In more than 1/3 of these countries, per capita incomes in 2024 will still be below 2019 levels. This feeble pace of income growth will entrench extreme poverty in many low-income countries. What are your thoughts on the present global economic forecasts? Share your opinions in the comment section below. Also, don't forget to hit that like button, subscribe, and turn on notifications for future videos. Thanks for watching.